understanding residency rules and regulations for tax purposes. Owning property in multiple states and traveling from one state to another for business or leisure can impact your tax liability in each state. Most US states have a limit of the amount of days you can stay in the state without paying taxes. If you conduct business as a resident of a state that is different to your home state residence, there may be tax conditions and benefits. Before we go any further, you must understand the meaning of domicile. So what is domicile? A domicile is a permanent home in which you live indefinitely or for some time without the intention of moving. You can only change domicile once you move. Why considering residency tax is important. A new job or the ability to work remotely has encouraged many professionals to either change states or spend more time traveling between states while working. The issue with traveling between states for business or leisure comes in when people aren't cognizant of their tax limits. Each state has a tax code for changing residence or domicile. Some major tax implications of changing your residency. In most states, you must file a tax return in both jurisdictions for the year you moved when establishing a new domicile. However, this could result in dual residency issues. Some states may recognize you as a full-year resident if you have stayed in the state for 183 days or more, while other states may have different thresholds. It is important to keep a detailed and accurate log of how many days you spend in each state, which could mean seeking advice from a multi-state tax expert. Residents who moved to Texas, Tennessee, or Florida in the beginning of 2022 may not be subject to personal income tax. In other states, you may need to report your income from all sources as a full-year resident, which will decrease your tax obligations depending on the time you live there. Some factors that determine residency tax status. While the residency tax requirements may differ from state to state, there are some factors that all states will use to determine your residency tax liability. These include whether you are legally considered a resident of a particular state, the amount of time you spend in each state, the location of your spouse and children, and the state where your vehicles are registered. Residency taxes, multi-state tax filing, and accurately filing your business taxes can be complicated tasks to perform and track, especially when traveling across states regularly. Residency tracking software can help you manage the amount of days you spend in each state. This will help you keep track of the taxable days in each state. It is highly advisable to partner with an expert to help you manage your taxes if any of the above applies to you. Our certified public accountants have extensive experience in residency rules and taxation, so schedule a discovery call to meet with us.